Okay, so today we're doing a deep dive into one of the most comprehensive corporate documents out there, really. It's the 2022 Shareholders Letter from JPMorgan Chase.
And this thing, it's much more than just, numbers on a page. It's basically a strategic briefing. Global risks, how they see the wind shifting, company philosophy, it's all in there.
Right. And for you, the highly engaged learner, this is kind of your shortcut to understanding how a giant financial institution dealt with the absolute chaos of 2022.
Exactly.
So our goal here is to pull out those core management lessons, thinking especially about risk, tech, and just surviving all that geopolitical turmoil.
And turmoil really was the word for 2022, wasn't it? The letter paints that picture clearly. You've got the war in Ukraine starting, rapidly increasing global tensions, particularly with China. Then domestically, inflation hitting what, a 40-year high? About 9%.
Oof. And markets all over the place. Stocks down 20%.
Right. Plus the lingering effects of COVID-19 sort of hanging over everything.
But, okay, despite all those storm clouds, JPMorgan Chase actually reported record revenue. How does that even happen? How does a bank thrive when everything seems so shaky?
Well, that's the central puzzle the letter tries to explain, isn't it?
Yeah. What's the number one factor they point to?
They argue that the consequences of all this instability, like the potential big shifts in the global order, those are actually much more important than just the day-to-day market ups and downs.
Okay.
And their success, they credit it to an almost obsessive focus on maintaining what they call a fortress balance sheet, something built up over many, many years.
That idea, the corporate fortress, it's pretty powerful, especially when you look at the numbers. Record revenue, again, 5th year running.
Yep, $132.3 billion, and net income of $37.7 billion.
Those are just staggering figures given how messy 2022 was.
It really shows, strong underlying business performance and very strict credit discipline, even when the global economy was, suffering.
And critically, they didn't just turtle up, did they? They kept investing.
That's key. They kept spending huge amounts on products, on technology. That really speaks to their core principles, how they run the business long term.
And those principles, they seem quite specific in the letter. It's not just about hitting the next quarterly target.
No, not at all. They really hammer home this idea that you only build real shareholder value if the company itself is healthy. And that means taking care of all the stakeholders.
Customers, employees, communities, the whole package.
Exactly. For them, the real measure of progress isn't the quarterly blip, it's the long-term stock price. And that's driven by making those continuous, sometimes tough investments in people, systems, products.
And they've got the results to show for it, right? They mentioned outperforming the S&P 500 and the financials index significantly since that big merger back in 2004.
They do. It backs up their view that investment isn't some optional extra you cut when things get tight. It's fundamental. A necessity.
And they connect that philosophy to actual community impact, too. That $30 billion racial equity commitment, for example.
Yeah, that's a huge one. By the end of 2022, they were already nearly $29 billion towards that goal.
Wow.
And a big chunk, like $18 billion in loans, went to preserving nearly 170,000 affordable housing rental units. That's tangible stuff.
Those big numbers show scale, definitely. But I thought the details on their hiring practices were also really interesting. The veterans hiring.
Oh, yeah. Over 18,000 veterans hired since 2011. And they employ around 3,000 military spouses, too. It shows a different kind of community commitment.
And they use Ohio as a specific example, don't they, to show local impact?
They do. It's a great case study. They're the largest private employer in Columbus. Over 20,000 people in Ohio work for JPMC.
And that detail about the starting wage in Ohio, I think that really lands the point. Their lowest starting wage is $31,000.
Plus benefits worth another, $15,000 or so?
Right. And you compare that to Ohio's per capita income of around $35,000. It's a massive difference for people. How do they frame that? Is it just competing for talent or something more?
It's framed as both, really. I mean, sure, they need good people, but it's also presented as being vital for the health of the communities where they operate. The idea is, you can't really have a thriving bank in a community that's struggling.
Okay, so that fortress idea suggests they felt strong internally. But the wider system, it clearly had weak spots. We saw that with Silicon Valley Bank and Credit Suisse blowing up. Let's talk about those failures. What did the letter see as the root cause there?
The big takeaway, and it's a pretty sharp critique of the whole industry, is that just meeting the regulatory requirements is, nowhere near enough for proper risk management.
So ticking the boxes isn't sufficient?
Not even close. That's kind of the mic drop moment in that section.
So if just following the rules wasn't enough, What did JPMC do differently, according to the letter, compared to, say, SVB?
Well, with SVB, some risks were just hiding in plain sight. Massive exposure to rising interest rates, for one, and the falling value of their held-to-maturity, their HTM bond portfolios, which, basically allowed banks to avoid marking losses immediately if they planned to hold the bonds long term.
Okay, so those were the known risks. But the failure happened incredibly fast. What was the unknown risk that tipped it over?
This is the really fascinating part. The letter points out that SVB had something like 35,000 corporate clients.
Okay.
But a huge chunk of those were effectively controlled by just a small number of venture capital firms. And those VCs pulled their clients' deposits almost simultaneously, in lockstep, as the letter puts it.
Wow. So a coordinated bank run, essentially, driven by a few key players.
Exactly. And that kind of concentrated, rapid withdrawal risk, that's not something standard regulatory models were really designed to catch.
And there's a kind of irony here, too, isn't there, with the regulations themselves. Banks were pushed to hold supposedly safe government bonds because they had low capital requirements.
Right.
But then those same safe assets became toxic when interest rates shot up.
Precisely. And the letter points out another irony. The Fed's big annual stress test, the severe scenario they model, it never actually included interest rates going up that high, that fast.
So the main test missed the main risk that actually materialized.
It highlights how relying on just one hypothetical scenario can create, a false sense of security for the entire system.
Now, JPMC obviously defends the need for huge global banks like themselves.
Yeah.
But is that just self-interest talking? How do they justify their scale?
Well, they argue for a tiered system. They make it clear they support strong regional banks. In fact, they provide banking services to about 350 U.S. banks themselves.
Okay.
But they argue that for things like complex global M&A deals or managing custody and payments across, say, 50 or 60 different countries, you just need the scale, the complexity, the capabilities that only the largest global institutions have.
Right. But while banks are dealing with all this, there's another huge shift happening: the rise of shadow banking, competition coming from outside the traditional system.
Yeah, this is a massive trend the letter digs into. Banks, relative to the size of the global economy, are actually shrinking.
Really? Shrinking?
In relative terms, yeah. While the size and influence of shadow banks, think private equity, hedge funds, private credit funds, that's growing rapidly.
And new regulations might actually speed that up.
That's the concern. Things like the proposed Basel III endgame rules, if they significantly increase, the capital banks need to hold for certain types of lending.
It makes that lending less profitable for the banks.
Exactly. So that activity gets pushed outside the regulated banking system into the hands of these non-bank players.
And it's not just financial firms they're worried about competing with, is it?
Yeah.
They mentioned big tech.
Oh, yeah. Competitors that are already 100% digital with absolutely enormous resources.
Like who?
They specifically name Apple, already huge in payments and dipping into credit, and Walmart. Think about it. Walmart has, 200 million customers walking into their stores every week. They have this massive existing customer base and huge resources. These companies are digital natives, and their potential reach in financial services is, frankly, terrifying for traditional banks.
Okay, so facing these digital native giants, how is JPMC fighting back on the technology front? What's their big move?
It comes down to just sheer massive investment. They talk about their tech flywheel.
They'll flywheel.
Yeah. They've got over 300 AI use cases already running in production, doing everything from, reducing risk and spotting fraud to making their trading operations smarter.
And the people behind that.
Huge numbers. Over 900 data scientists, 600 machine learning engineers. They are seriously investing in talent.
And that investment must connect to their big cloud migration push, right?
Yeah.
They mentioned spending $2 billion on new cloud data centers.
Absolutely. And that's where you see the sheer operational challenge. They've moved about 38% of their applications to the cloud so far.
Which sounds like decent progress.
True. It is. But the really hard work is replatforming or refactoring something like 4,000 applications to actually take full advantage of the cloud. That's not just lifting and shifting old code.
That sounds like a massive undertaking.
It is. They actually cite it as their single biggest operational risk, just the sheer difficulty of modernizing decades of legacy systems without breaking anything along the way.
Okay, shifting back to risk management. We talked about regulatory minimums not being enough.
Yeah.
JPMC seems to go way beyond that, performing hundreds of stress tests a week.
Yeah, they're almost fanatical about it. And they're quite pointed in their critique of the Fed's main annual stress test, the CCIR.
The Comprehensive Capital Analysis and Review.
Right.
What's their beef with it?
They basically argue that the Fed's single hypothetical scenario, which comes up with this arbitrary loss estimate for them, like $44 billion over 9 quarters, they think it's just not realistic. It's inaccurate.
Wait, they think they wouldn't lose $44 billion? They think they'd actually make money in the Fed's severe downturn scenario.
That's their bold claim, yes. They point to how they actually performed during the real-world stress of the March 2020 market meltdown.
What happened then?
Their trading desks actually had higher than normal revenue because they kept operating, kept making markets for clients when many others pulled back. So they argue their actual ability to absorb losses and keep functioning is much, much greater than the regulators' models predict.
Fascinating. Okay, finally, let's touch on interest rates.
Yeah.
The letter uses this amazing phrase, calling rates the cosmological constant of finance. That sounds profound. What do they mean?
It's a great analogy, isn't it? Just like a constant in physics might shape the universe, interest rates fundamentally shape all economic and financial calculations.
How so?
They give a simple example. Think about the net present value, the NPV, of getting $1 every year forever. At a 1% interest rate, that annuity is worth $100 today.
Okay.
But crank the interest rate up to 10%, that same $1 annuity is suddenly only worth $10 today.
Wow, that's a huge difference.
Exactly. That sensitivity impacts everything. How you value a company, whether an investment makes sense, everything flows from that rate.
And based on that constant, they saw some pretty big warning signs, like the inverted yield curve.
Yeah, they point out that historically, a sharply inverted yield curve like we saw has been, quote, 8 for 8 in predicting a recession within about 12 months. It's a very reliable, if unwelcome, signal.
And their outlook based on that wasn't exactly rosy.
No, they suggest that the combination of QT quantitative tightening, where the Fed pulls liquidity out of the system combined with continued high government spending, it creates this difficult mix.
Forcing the Fed's hand.
Potentially forcing the Fed to push rates even higher than people were expecting at the time. They were bracing for rates possibly hitting 5%, 6%, maybe even 7%. Tag outro.
Right. So let's try and wrap this deep dive up. Internally, you have this picture of JPMC as this incredibly resilient entity. Record results, huge investments in tech and people, that fortress balance sheet.
Right. Real internal strength.
But externally, the world they're operating in is just incredibly complex and uncertain. Geopolitical risk is accelerating. We saw the banking system wobble, deep structural changes underway.
It's that contrast that's so striking. The core lesson, I think, for you listening, is really about the need to be proactive. Manage risk obsessively, way beyond just ticking regulatory boxes.
And adjusting strategy fast.
Adjusting strategy fast when the economic reality changes, because the world is changing fast. And complacency, well, that's the real killer in this environment.
So what's the final provocative thought we should leave people mulling over after digging into JPMC's view of the future?
I think it's this idea hinted at strongly in the letter that the global economy might be making a fundamental shift, moving away from decades defined by a savings glut, where capital was easy and cheap,
Right.
towards a new era defined by scarce capital. And if that happens, it's not just a short-term cyclical thing, it's a deep structural sea change. Meaning we could be moving from what they call a virtuous cycle of low inflation and low rates to potentially a vicious cycle where higher inflation and higher interest rates become the norm, much more persistent than we've seen recently.
And that changes everything.
It changes everything, how capital markets work, how risk is priced, how investments are valued, potentially for decades. That's the really big, maybe unsettling possibility to chew on. That's the new landscape we might all need to learn to navigate.